Let us see the next question. An American firm is under an obligation to pay interest 10,10,000 Canadian dollar and 7,05,000 Canadian dollar on 31st of July and on 30th of September respectively. So there are two dates that they have provided, and on these two dates the payment is required to be made. One is 31st of July. On that date the payment is supposed to be made 10,10,000 Canadian dollar, and another is 31st of October, and on that date it is 7,05,000 Canadian dollar. The firm is risk averse, means the company wants to take less risk so far possible, and its policy is to hedge the risk involved in all foreign currency transaction. So policy of the company is to hedge all foreign currency transactions. The finance manager of the firm is thinking of hedging the risk considering two methods, that is fixed forward or option contract. So in case of fixed forward, what will happen? There will be a particular rate at which the conversion will take place for purchasing of the Canadian dollar for making payment. It is now 30th of June. So today's date is 30th of June, like that information is given. So there are two dates on which we have to make the payment. One is after 1 month and another is after 4 months. Okay. Oh, the second one is 30th of September. So it is another is after 3 months. Following quotations regarding rates of exchange for US dollar or Canadian dollar from the firm banks were obtained. Spot exchange rate is provided to us. It is dollar per Canadian dollar. 1 month forward exchange rate is given and 3 months forward exchange rate is given. The price of Canadian dollar per dollar option on the US stock exchange, cent per Canadian dollar, payable on the purchase of the option. Contract size is 50,000 Canadian dollar. So new information is introduced over here, that is the lot size, and as follows. The exercise price is given to us, dollar per Canadian dollar. It is 0.93, 0.94 and 0.95. We have been provided with the premium for the call option and premium for the put option for the month of July, for the month of September, for the month of July and for the month of September. And importantly, they have specified that say the premium is provided to us cents per Canadian dollar. Okay. According to the suggestion of the finance manager, if options are to be used, 1 month option should be bought at strike price of 94 cents and 3 months option at the strike price of 95 cents. Okay, so for 1 month we should enter into the transaction for 0.94 cent, that is $0.94 per Canadian dollar, and for 3 months it is $0.95 per Canadian dollar, like that information is given. And for the remainder uncovered by the option, the firm would bear the risk itself. For this, it would use the forward rate as the best estimate of the spot. Transaction costs are required to be ignored. So whatever the brokerage that you have to ignore, but of course you don't have to ignore the premium, because for premium specific information is given by them. Recommend which of the above two methods would be appropriate for American firm, that is for the US company, to hedge its foreign exchange risk of the two interest payments, that is after 1 month and after 3 months. That is what they have provided. I request all of you to properly go through the question and then we will discuss how to do it. Let us have understanding that say how to make calculation of the answer. Friends, of course you must have understood that we are required to take the decision from the US company point of view. There are two interest payments, one is for 1 month and another is for 3 months. The amount to be paid in the Canadian dollar currency, the amount to be paid is given to us and the forward exchange rate is provided to us as dollar per Canadian dollar. As far as the option contract is concerned, for that so the information is given to us regarding exercise price, regarding premium, and one more important information given this time is the lot size. With the introduction of the lot size, how we are required to calculate the answer, that we are going to discuss say in some time. First of all, I would like to say complete the working for the forward market hedge. So I request all of you to write down answer along with me. Heading write down forward contract. In that write down forward contract will be entered upon, comma, to purchase 10,10,000 Canadian dollar after 1 month, comma, $7,05,000 Canadian dollar after 3 months. Full stop. So write down answer. For 1 month, the forward exchange rate is provided as 0.9301 dollar per Canadian dollar. So this is the amount of the dollar which is supposed to be sold for purchasing 1 Canadian dollar. For purchasing 10,10,000 Canadian dollar, we are required to sell this amount of dollar currency. And it will be found like this: 0.9301 into 10,10,000 divided by 1, but that does not make any sense. It is 9,39,401. This is the amount of the dollar which is supposed to be sold. And 3 months, for that also similar working is required to be made. We have not been provided with the buying and selling rates, so there is no issue of recognizing the proper rate also. 3 months forward exchange rate is 0.9356 dollar per Canadian dollar, and amount to be paid after 3 months is 7,05,000. And this is the amount of the dollar that you are required to sell. So it is 0.9356 into 7,05,000 divided by 1, but that does not make any sense. $6,59,598. 6,59,598 amount of dollar. This is required to be sold after 3 months to buy required amount of the Canadian dollar to be paid. This is very simple. Now we are entering into the option market hedge. So the second one is option contract. Let us have understanding that in case of option contract, how to calculate the answer. Now friends, importantly over here, there are three exercise prices have been given to us. So of course, it was mandatory to give one of the exercise price at which the contract will be entered upon. So they have provided over here with a clarity that 1 month option contract will be bought at strike price of 94 cents. Means $0.94 is required to be paid for say purchasing $1. That is what we understand. So over here the exercise price on which we are required to focus is, that is option contract. In that I am writing 1 month, that is for the month of July. In that say they have provided a clarification, dear students, that the exercise price is $0.94 per Canadian dollar. This is what we understand. That is to buy 1 Canadian dollar, so you are required to pay say $0.94. Now second important point over here is the lot size. We understand that say the contract and amount. If at all you enter into one contract, it is deemed that say 50,000 Canadian dollar is purchased or sold simultaneously. The lot size concept that we have in the derivative is required to be applied over here. That is, in case of F&O transaction of the stock market, you are aware that say if at all you are entering into the transaction to buy Reliance, and that is the stock of the Reliance is 150 shares, then you have to buy 150 shares or 300 shares or 450 shares or in multiple of that only. You cannot buy say 100 shares in the futures contract if at all the lot size is 150 shares. So 150 shares or in multiple of that only, so you can enter into the transaction. Now you know that say after 1 month you are required to pay 10,10,000 Canadian dollar. So in order to say use the option contract as a method of hedging, you have to enter into a specific number of contracts. So what is the number of contracts in which you can enter upon? 10,10,000 upon 50,000. Answer comes to 20.2. Of course, you cannot enter into the fraction number of contracts, so you have to enter into either 20 contracts or you may enter into 21 contracts. But since 20.2 is near to 20, so we will enter into 20 number of contracts. That is what we understand. Do not write anything, let me explain to you. So what will happen, dear students, we understand that say it is 10,10,000 into 1, that does not make a sense, divided by 50,000, that comes to 20.20. But of course you cannot enter into fraction number of contracts, because in that case say the lot size concept itself will not have any significance. Of course, this is what we understand. So 20 contracts into 50,000. Okay, because we understand that say you enter into 20 contracts. In each contract you will have the transaction for 50,000 Canadian dollar. So for 10 lakh Canadian dollar, you have got say hedging say through option contract. The total amount that you have to pay is 10,10,000. So what about the remaining $10,000? I'm sorry, what about the remaining 10,000 Canadian dollar? For that, a very good clarification made in the question that for the remaining amount of the 10,000, which is negligible one, you may assume whatever the forward exchange rate which is prevailing right now itself would be the spot rate at that point of time. So the language of the question speaks like this. And for the remainder uncovered by the option, that is 10,000 Canadian dollar, the firm would bear the risk itself. For this, because for the purpose of decision making, you have to consider the cost for that purchasing 10,000 Canadian dollar. For this, it would use the forward rate as the best estimate of the spot. Okay. So what is forward exchange rate? Forward exchange rate is 0.9301. So into 0.9301. So the answer is $9301. Okay. So for the 10,000 Canadian dollar, this is the cost. And say as far as this 10,000 Canadian dollar is concerned, for that the exercise price is $0.94 per Canadian dollar. So to buy 1 Canadian dollar, you have to pay $0.95. So for 10 lakhs Canadian dollar, this is the amount of the dollar that you have to pay. So kindly use your calculator. 10 lakhs into 0.94. That comes to $9,40,000. Now there is one more thing which is remaining, is the premium amount. Okay, now understanding the next point, listen carefully. We understand that say we are supposed to consider the premium. Now friends, you have to see importantly that the lot size is provided to you in which currency? Lot size is provided to you in Canadian dollar currency. Plus, you have to see that say in which transaction you are interested in. You are a US company and you are interested in the transaction of sell of dollar and purchase of Canadian dollar. So what happens friends over here? US company is required to enter into option contract to purchase Canadian dollar. That is purchasing right to purchase underlying asset, that is call option. Yes, this is the important point in my opinion in the example. You have been provided with the information about the lot size of Canadian dollar. You are entering into the transaction to purchase Canadian dollar. So you have to purchase the right to purchase Canadian dollar. Means you are required to say purchase call option. So over here friends, we understand that say we will be entering into, listen carefully, for the month of July in call option for exercise price $0.94 per Canadian dollar and the premium is 1.02 cent. 1.02 cent per Canadian dollar. That is what they have provided to us. Coincidentally over here, you can see that they have not provided put premium. However, if at all it would have been provided, it is of no use to us. And conceptually you should understand that say you are supposed to purchase the call option. So now the remaining answer is very simple. We understand that say if at all you purchase right to purchase 1 Canadian dollar, then in that case you are required to make the payment of the premium of 1.02 cent. 1.02 cent. So 1.02 divided by 100. So I convert that into dollar term. So 1.02 upon 100. It comes to 0.0102. This is the amount of the dollar to be paid in form of premium. What is the amount of the consideration? 10 lakh, 10,000. So this is the premium which is required to be paid in dollar currency. So 10 lakh 10,000 into 0.0102. So it comes to, I'm sorry, it is 10 lakhs. Okay, because the 20 is the number of contracts. So this is 10 lakhs. 0.0102 into 10 lakhs. That comes to 10,200 US dollar. That is the amount of the premium which is required to be paid. So if at all you enter into the option contract, then in that case basically there are three expenses. One is the payment that you are going to make in the option contract, second that you are going to make the payment of the premium, and third you are going to purchase Canadian dollar currency from the spot market. Total of this three is the maximum cost that you will have if at all you enter into the option contract. This is what we understand. Now friends, I used the word maximum cost. Why did I use that word? Because you can definitely understand that suppose by chance in the spot market you can purchase 1 Canadian dollar at a rate which is less than $0.94, then in that case you would prefer to buy Canadian dollar from the spot market rather than by exercising the option. This is what we understand. So heading right down, option contract, in that write down July month. In that working note number 1, calculation of number of contracts. Contract and amount. Amount in Canadian dollar term. So if at all you enter into one contract, it is deemed that 50,000 Canadian dollar, for that the transaction is entered upon. The consideration is 10,10,000 Canadian dollar. So it is equal to this number of contracts in which you should enter upon. So 10,10,000 into 1, that does not make a sense, divided by 50,000. That comes to 20.20 contracts. Full stop. With paragraph write down. So American company can enter into either 20 contracts or 21 contracts. Full stop. Assuming that $20 contracts are entered upon comma, answer is found. Working note number 2, calculation of shortfall in payment in bracket I am writing Canadian dollar if 20 contracts are entered upon. So in that write down, total payable amount minus amount paid with option contract. Total payable is 10,10,000 minus amount paid with option contract is 20 contracts into 50,000. So 10 lakh 10,000 minus 10 lakhs. So it comes to 10,000 Canadian dollar. That is what we understand. Working note number 3. Calculation of amount payable in dollar for purchasing $10,000, 10,000 Canadian dollar after 1 month. And friends, for this we are assuming the spot rate itself would be the rate at which we will buy it. So that is 0.9301. So dollar Canadian dollar 0.9301 dollar for every 1 Canadian dollar. So this amount of the dollar for purchasing 10,000 Canadian dollar. So in that case it is 0.9301 into 10,000. So $9301. This is required to be paid for purchasing the required amount of the dollar which is not hedged by the company. And this is of course not very significant value in comparison to the overall payment. Working note number 4. Calculation of premium. In the write down, we understand that lot size is in Canadian dollar currency term. Full stop. US company is entering into option contract for sale dollar, purchase Canadian dollar. Full stop. So US company will purchase right, comma, to purchase Canadian dollar, full stop. So call option is purchased. Full stop. Amount of call premium is found as under dollar Canadian dollar. You purchase right to purchase 1 Canadian dollar, the premium is 0.0102. That is 1.02 cent divided by 100. The way we convert like 75 paise in rupees, then it is 75 upon 100 that comes to 0.75 rupee. Similarly, say 1.02 cent is converted into dollar and you enter into the transaction for 10 lakhs Canadian dollar. So 20 contracts into 50,000. So this is what we understand is the amount of dollar which is supposed to be paid in form of premium. So 10 lakhs into 0.0102, that is $10,200 that is required to be paid. Okay. Next, calculation of total cost. In that, say we will have, that is of course in the dollar currency, particulars and amount. The first is amount payable in option contract. So in that it is 50,000 into 20. So this is the amount of the Canadian dollar into 0.9301. So 50,000 into 20 is of course 10 lakhs into 0.9301 is 9,30,100. Then amount payable in forward contract. We can see that so the amount payable in forward contract is $9,301. Oh, I'm sorry, I have taken over here wrong. This is 94, I'm sorry. It is 0.94. So 50,000 into 20 into 0.94. So 9,40,000. Because exercise price is 94 cents. Then amount of premium. That is supposed to be paid 10,200. No interest rate is provided to us expressly, so we are ignoring the interest on premium. With that, so we will compute the total amount. It is 9,40,000 plus 9,301 plus 10,200. So 9,59,501. So over here 9,59,501. This is the amount that say you have to pay same dollar currency. This is for 1 month and similar working is required to be made for 3 months. For 3 months, I request you to put your answer in the chat box. Then I will be doing answer for you. Let us say that's in case of 3 months, how to do answer. Now in 3 months, it will be relatively simple for you to understand. Again, working note number 1 is calculation of number of contracts. Number of contracts can be found like this: contract and amount in Canadian dollar currency term. Entering into one contract means 50,000 Canadian dollar is purchased or sold. The consideration to be paid is 7,05,000. So we understand that's over here 7,05,000 into one that does not make a sense, divided by 50,000. So the answer comes to 14.1. 14 is near to it, so we'll enter into 14 contracts. So enter in 14 contracts. Working note number 2. Calculation of amount payable in dollar currency after 3 months, comma, to cover up the shortfall. So we understand in that the working will be made like this. Dollar Canadian dollar. We can see that over here the forward exchange rate is 0.9356. So 0.9356 dollar per Canadian dollar. Now what is the amount of shortfall? We can understand 7,05,000 minus 14 into 50,000. So 7 lakhs is the amount which is arranged to the option contract. So the remaining 5,000 for which you have to enter into the forward contract. So this is the amount for which the forward contract is required to be entered upon. So 0.9356 into 5,000 divided by 1, that does not make a sense. So the answer is 4678. That is the amount of the dollar which is supposed to be paid, say, to cover up the shortfall. That is what we understand. Working note number 3. Calculation of call premium. Again friends, we have to enter into the call option only and the call premium. So you have to focus again in the call option column, not on the put option column. For September, we can see that the exercise price is 0.95 and for that the premium amount is 1.64 cent. Okay, so call premium, dollar Canadian dollar. You purchase, right to purchase 1 Canadian dollar, it will cost you 1.64 cent. It means it will cost you $0.0164. So it is 50,000 into 14. That comes to 7 lakhs. So to purchase right for 7 lakhs Canadian dollar, you have to pay this amount in form of premium. 7 lakhs into 0.0164 divided by 1. Because the only 14 contracts are entered upon. That comes to 11,480. So that is the amount of the dollar of the premium to be paid. And in my opinion, say, understanding that you have to buy the call option is very important. That is what I believe. Last is the calculation of the total amount. That is in the dollar currency. So the amount paid through option. How much amount? We understand that say it is 14 into 50,000. That comes to 7 lakhs into 0.95. That comes to 6,65,000. Okay. Then amount payable in forward, that is straight to purchase, so the remaining 5,000. For that it is 4678, and the last is the call premium. The amount of the call premium is 11,480. That is the way the total amount is calculated. 665 plus 4678 plus 11,480. That comes to 6,81,158. This is the amount of the dollar to be paid. So this is the way we make the calculation of answer. Friends, most importantly, I revise you the working for the option contract. The first is the number of contracts. You enter into, let us say, 14 number of contracts. Taking into account the lot size and the amount of the consideration, we determine that what is the number of contracts to be entered upon. Second, payment of the shortfall. For that, the forward exchange rate is the best estimate of the spot. Third is the very important working note, call premium. Whatever the option contract in which you enter upon, for that you have to pay the premium. Of course, it is required to be paid right now, but the interest rates are not given, so we are ignoring the time value of money. So the total amount payable in the option contract is 1. It is required to be paid through the option contract. Second, the amount to be payable in forward contract for the shortfall amount. And the third, it is call premium. This is the way the total cost will be calculated. Once we make all these calculations, now we are required to make a comparison. So we understand that, say, for the payment of the July and for the payment of the September, forward market hedge, option market hedge, forward market hedge and option market hedge. We are required to, that is say, select an alternative which is having the lower cost. So over here 681158, that is what we understand. Similarly over here 959501. So over here it is 959501. In case of the 1 month forward 0.9301 into 10,10,000, it comes to 9,76,605. So option is better than forward. And for 3 months 9356 into 7,05,000, that is 6,59,598. So in that case, so the forward is better than the option. That is what we understand. So here we can see that, so for 1 month it is 939401 and for 3 months it is 659598. Sorry friends, for 1 month the amount that I have written is wrong. It is 9,39,401. Okay, so in both the cases we understand that, so the forward is selected and not the option. However, we can always understand that, say, if at all the spot exchange rate is more favorable, then in that case the option contract cost can reduce. However, in case of the forward it will not reduce. This is what we understand. So write down final answer. The company should enter into forward contract. Full stop. This is what we understand.